Rajendran, pleasure to have you here for this webinar. I've been a big fan of all the work that you've been doing at Thermax and really sort of leading from the front when it comes to driving best practices in financial corporate finance. So super excited to hear from you, and I'm sure the audience will benefit from it as well. Maybe to begin with, Rajendran, would love to, hear a little bit about your story, your background, and your journey to where you are today. Including a little bit about Thermax. Maybe we can, start with that.
Sure. Thanks, Ankur. Thanks first for the opportunity to be on this webinar platform, and happy to be here. So I think I am an management graduate from BITS Pilani, and I think an hallowed institution which is known for its engineering program rather than anything else. But I think I'm a management graduate from there. Then I've done my certified public accountant CPA from USA. I'm also an CGMA and an FCMA degree holder. I think those are my professional qualifications. I think I started my career with Thermax and then moved on to auto component industry, where I spent close to 10-11 years. And now I'm back with Thermax. And I think that's, in short about my professional journey. Talking about Thermax, I think Thermax is, as you all know, is an engineering major, a capital goods provider in the Indian space. We, of course, call ourselves an Indian MNC because we are present globally across quite a few geographies, including manufacturing locations in Indonesia, Denmark, Poland, and so on and so forth. Apart from our, existing portfolio, of late we have, transitioning to be a trusted partner on the energy space for the corporates. Essentially, we're focusing on the new energy transition that's happening. That's primarily the solar, the bioenergy, the green hydrogen, so on and so forth. So I think those are the spaces that we are focusing upon today. There are developing technologies in these, and we hope to be one of the leading players in this segment going ahead. So that's, I think, in short about Thermax.
Sounds like a very exciting journey going forward as well. I think it does seem like an inflection point from the climate perspective as well, and the focus on green energy. So super excited to see how Thermax evolves in the coming years. Rajendran, wanted to use today's time to actually talk a little bit about your supply chain in particular. And Thermax, I understand, has a very large base of suppliers, a fairly complex sort of supply chain, many various components that go into building capital goods. Would love to understand a little bit about how you thought about the underlying supply chain of Thermax, and what was what were the underlying problem statements you've been looking to solve over the past couple of years with respect to your supply on the vendor side. Maybe you could elaborate a little bit there.
Sure. Thanks. So see, I think companies like us, I think, rely a lot on supply chain. While I think that we have a bit of a product piece, regular products that we manufacture, but we also have a large project business within us. And project business is primarily a supply chain backbone. And, so I think that's something that is very important for us to ensure that they are, taken care well. And in that context, I think the supply chain of Thermax, I think, constitutes of some large suppliers, corporates as well, but also a lot of MSME vendors and medium scale vendors who are smaller than us in terms of their balance sheet size and so on and so forth. And I think that's we nurture for mutual interest.
Yeah. And when you thought about dynamic discounting as a value proposition, I'm sure there would have been some underlying problem statements that you wanted to solve. What was the genesis of the thinking behind looking at dynamic discounting as a value proposition, when it comes to Thermac's context?
Yeah, so I think uh, most vendors, I think, have a challenge on the working capital side. When you deal with them, you appreciate that even though in the Indian context that now there is financing which is available through different sources, be it the banks, the NBFCs, the various tech platforms, P2P lending, so on and so forth. I think there is enough of financing options that are available to various of the vendors that we deal with. But I think whether they are the best sources of finance for them, best terms that whether they get along with that, uh, whether it is ease of look at them, then there is clearly a situation where they can be better served on the financing front. And I think a partner who is well financed or has a better cash flow is always a good partner for us. End of the day, I think those are clearly issues that I think we as a corporate, and I think any corporate will have to take care vis-a-vis the vendors. Having said that, I think we have also seen consistently that vendors, while keen on financing, don't have the easy access, in terms of the availability. They necessarily have to, go through a program where they have to offer a security or a lot of documentation, or face higher interest rates, and so on and so forth to access financing. And I think that's true of smaller corporates in India today. And that's because of, their size and scale that they have. And I think this is where I think corporates like us can come in to find some solutions which eases out this particular working capital challenge for these entities. And finally, the capital plays the important part for them in terms of their growth. And so it's very imperative that we help them out on this. And we have looked at the vendor discounting space for a long time. We've tried various solutions in this regard. And I think, let me say that, traditionally, till about few years back, it always used to be through the banking channel that the vendor discounting programs used to run. And you had a peculiar set of challenge channels, because essentially they would come up with either which is very stringent on the corporate side, in case it is dependent on the credit risk is being taken on the corporates, or a more stringent documentation on the vendor side in case the risk is being taken on them. And so this end of the day would lead to a situation, if it is on the corporate, then it would start showing up in the corporate side of the balance sheet as borrowings or acceptances, but in case if it was going to be on the vendor side, it will have to be the vendor's existing banking arrangements will have to be informed, and where a lot of documentations needs to be completed, including board resolution, so on and so forth, etc., with the vendors. And so it was not an easy implementation solution for corporates. Over and above that, I think the terms of the financing always used to be some fixed interest rate that you had to agree between the corporate and the bank, which will be offered to the vendors. And vendors of varying sizes. There could be big vendors, small vendors, but all of them will have one fixed interest rate kind of a model. And these fixed interest rates were not flexible in terms of the market movements. So you had to go back, negotiate. The bank always had a reluctance to change those interest rates, because obviously when the interest rates have gone down, they were making a better margin, and so on and so forth. So I think this program had lots of challenges, and I would believe that this space really never took off in a big way. Though I think many corporates were practicing it, but my understanding is it didn't take off in a big way, helping vendors and nor helping the corporates in a big way. It did help in a small way compared to the market size and potential that there was. And I do see that the government also stepped in terms of MSME financing support, the platform that they introduced, etc. But I think even whether that was user friendly, whether it really did take off the way it was supposed to be, etc., I think remained a question. So I think these were some of the thoughts and issues that was on the table as we evaluate the vendor bill discounting situation and structure as it was existing a few years back.
And just to build
So
on
I
that,
think if I were to continue on to talk about yeah, sure, please go ahead.
there's a bit of lag. Just one question there, Rajendran. So, did you actually see vendors approaching Thermax saying, "Hey, we need liquidity support," or was it more a proactive measure on your part to say, "Look, we are in a business where vendors are super critical, so why not extend a facility to them?" I'm sure in the past, a lot of companies have also explored, cash discounting as a means to help with, liquidity support to vendors. Was that something that Thermax had also explored in the past? How would you how did you evaluate that?
So, as I said, I think we had always wanted to offer such a facility to our vendors. We had different programs on running at this, in the past. We had certain hundi programs where we were financing it off our own balance sheet, discounting it upfront, and then some kind of an structure like that. We also had bank-based financing programs where the banks were offering some vendor bill discounting solutions, the ones like I talked earlier about. So I think we had those solutions, but to be very honest with you, none of these were very popular because they were, for the reasons that I explained, they didn't really take off in terms of volume, and not many vendors were benefited by whatever was being done by us. So I think from that perspective, moving on to the new age tech-based platform like CashFlow, I think has definitely brought in a lot of changes.
Understand. And if you could, for the benefit of the audience, talk a little bit about, what was the, solution that you felt like the cash flow solution that was implemented with vendors. And I think it's been over a year now, maybe a year and a half. What has been, the big change you've seen in your own supply chain on the back of the dynamic discounting solution? Any thoughts that you'd like to share there?
Yeah, so I think yes, we are there with CashFlow on the CashFlow platform for about, I think, close to 1.5 years, close to 1.5 to 2 years, as I would see it. I think the benefits of the program, as we understood initially in earlier dialogues, were that it's a tech-based platform. It had minimal documentation needs. It was user-friendly for vendors to operate and access. And CashFlow as a team would also be focused on reaching out the benefits to more vendors because I think the outcome was aligned to the interests of CashFlow. So I think these were things that was explained to us when we started the program, and I think the reality was also very similar. That I think what we have seen is that the ease of access, the technology-based solution, the interest rates being determined by the vendors as per their needs. I think these are all certain, I think, I would say USPs of a tech-based platform. And I think reasonably today, as when I speak across various corporates, I think most of them have switched over to this kind of a platform for vendor bill discounting for the obvious reasons of benefit that both sides, that is the corporate as well as the vendors, are seeing.
Yeah. One of the concerns corporates often have when it comes to technology-based dynamic discounting platforms is what is the effort needed on part of the corporate to run these programs on a sustained basis. Or, in other words, what are the key considerations that they need to keep in mind when it comes to, implementing such solutions? Any guidance from you based on your experience and your team's experience as far as implementing such solutions is concerned? Because I'm sure it's not something that can apply to each and every company, right? So are there certain guardrails or certain considerations that a CFO needs to keep in mind when they think about these solutions?
Sure. So I think, yes, there are, in a sense that I think CashFlow as a platform operates both on own funds of the corporate as well as through, where there can be a financing that can be organized, where the funds can be from a third-party source as well, as I believe. But we have primarily operated through our own funds on this platform, so I can only speak from that experience. I would say that some of the challenges, I think, while this can work on an manual basis in terms of integration between the CashFlow platform and the ERP that you typically operate with, the ideal solution in the situation is where there is a host-to-host connectivity of data transfer and then response. Yes, this we have actually funnily 3 ERPs running in our organization. So to that extent, we've had our timelines to integrate them to make this work seamlessly. So that's something that I would be that I think we all need to be aware of, that this particular aspect is where there could be some time consumption that can happen. The vendor acceptability to such tech-based platform, I think if there is a communication internally from our end, as well as supporting the program, as well as our supply chain teams, dialoguing about this availability of a program and the financing that can be accessed through that on a regular need basis with the vendors. I think those would definitely help. Apart from the bit that the CashFlow team as well does by reaching out to the various vendors in this regard. So I would really, I think the point, to make the best use of CashFlow, I think the challenge or the issue is really on the integration piece that you need to achieve to make it effective. I think that would be one I think talk about.
Yeah. I think in our experience as well, working with corporates across industries, we've seen that those who've embarked on the journey to integrate sooner than later have also realized that post integration, the day-to-day effort required on the part of the corporate actually comes down dramatically. And even though I think even with a manual process, on an absolute basis the effort is fairly low, but I think post integration, more than effort, I think it's also the peace of mind that everything is happening error free, and the buyer doesn't need to worry about incorrect discounting or double payments or any of those kind of risks that may arise. So I think that's integration definitely is an important step there. What about procurement and finance teams, right? So one of the things again that are a consideration for corporates is, of course, the vendor relationships are held by the procurement teams. Is this in your experience, from Thermax's perspective, does procurement get involved in running a program of this nature, or is it a fairly light touch model as far as procurement is concerned?
No, I think finance doesn't directly deal with the vendors on a day-to-day basis, and I think it's clearly the supply chain team, the procurement team, which has a direct connect with the vendors. Their stakeholder, their stakeholding or their alignment to this is absolutely required to make this program a success. And I think they're reaching out to the vendors and making this an important vehicle that is available for an ease of business between both the organizations is something that they can play a very effective role. So finance, while it can, I think, set this up from an documentation, from an accounting, from an linkage, ERP, financing, treasury perspectives. I think the vendor piece, which is an important one, I think that comes really from the supply chain and the procurement teams, and I think they are an important stakeholder.
Rajendran, how is, over the last 1.5 years, if I had to sort of ask you, how have your vendors taken to this program? Any feedback you heard from them?
So generally, I believe that they are they are quite okay. I think they are. I think they're receiving it well. We see the participation reasonably go up. We see that they are able to access as per their need, because this is a program which doesn't mandate them to discount their bills on an once they enter into the program on a daily or on a regular basis. So it doesn't force them to be on the platform and pay those charges. So to that extent, it's completely neutral, and I think that's definitely a welcome initiative for them, that they are not forced to accept a certain discounting charges as a part of their sales price. And I think the ease of access on the ease of access is something also which benefits them. So I've generally not becoming happy with the platform and the program.
Got it. And if I had to ask you from your own vantage point, what would you consider as, the impact that this initiative has created for Thermax and supply chain overall? How would you articulate that?
So I think I talked about the challenges that we were, typical corporates face in setup of an vendor bill discounting program, and smoothen the financing arrangement with the vendor and the corporate. And typically corporates, have their own cash flow issues and challenges sometimes, and they may not be on dot on the payment, on the due dates, and which builds an uncertainty to the vendor's cash flow, and which in turn impacts the whole business cycle. And I think the moment you have certain vendor bill discounting programs which help the vendors to access cash on an definitive basis at an attractive rates and with certain ease, I think it's going to resonate well with the business, and it's going to resonate well with the vendors as well. So I think there is an clearly an benefit that you can see on both sides of the table, which comes in on account of such successful programs. And I think I would definitely say that cash flow, has eased definitely an pain that was there in the process, and made it an win-win solution for both corporate and a vendor.
Great. No, thank you so much, Rajendran. I think this has been super insightful and very practical in terms of some of the issues you talked about prior and post implementation, how the change has really come about in your supply chain. So thank you for sharing that. One sort of last question before we open it up to the audience is that from your vantage point, you talked about ERP integration being a key success factor. Treasury, having a decent treasury allocation being another one. Anything else that you would add as sort of key success factors for such initiatives that, again, when a company is thinking about embarking on, anything else that they need to keep in mind? And finally, any words with regards to your experience with CashFlo, I think would be great to hear.
Sure. So as I said, I think the only challenge I would believe, which is a large challenge, there are, any what I would say as platform setup or involving three parties and multiple parties, etc., have their own bit of issues that needs to be handled before it becomes an acceptable and a successful solution. But that's fairly understood, and they are typically not a big pain points, and it all depends on communication, setups, and I think commitment from all the three parties involved. I would rather, as I think I already mentioned to you, the key thing that for to make this work very seamlessly is really the ERP integrations, and I think that I think is the one that I think people will have to take note of. That smoothens out the process much more in terms of the flow of information and the reverse feed, and eases out a lot of accounting and manual monitoring that needs to be done. I think that's the important piece, I would say. And working with CashFlo, I think has been perfectly good. I think we've seen in the professional team work on the other side, keen to make the program work, keen to ensure that the vendors are reached out and they are benefited out of accessing the platform, marketing it well, and I think making it not a very heavy tech solution for anyone to use. I think it's fairly easy to use is what I believe. And I think, so I think those are definitely the positives that I see of having worked with Cash.
Thank you so much, Rajendran, for that. With that, we'll open it up for questions to the audience. Radhika, I think there are a few that we've received. Perhaps, we can go question by question and take up the queries.
Yeah, thanks, Ankur. So we have a few questions from A. Sayagraj. So Mr. Sayagraj, will you like to just unmute yourself and ask the questions yourself? So I'll be unmuting you and you can just ask the questions yourself once.
Radhika, I think we can ask the question, and then if
yeah,
he wants to add something, then he can do that. But
yeah. So what Mr. Sayagraj is asking is that what will be the accounting treatment when the vendors are financed from our own sources, for example, dynamic discounting. So whether, for example, whether it will be shown in the PNL and under what heading will it be shown?
Okay, so I think I don't think there is anything new about it, in a sense that you are paying your vendor or your creditor on the balance sheet at an early date upfront, and you are gaining a bit of discounting income on it, and so your creditor liability gets offset immediately because you are making the payment upfront, and your income gets booked to the extent of the discount that you have received on the liability that you have paid off. So I think that's a fairly straightforward one.
Thanks, Rajendran. So the next question that he has is, I think, Ankur, for you. What is the USP of CashFlo?
Look, I think since we started about 4 years back, we have learned a lot about supply chains. What are the needs of the vendors and what are the needs of corporates when it comes to providing liquidity within the supply chain. So, our product has also evolved many-fold since, we started. I think for us, one of the key goals has always been how do we create the best possible experience for the vendors and the corporates, which meant that, we innovated a fair bit on ease of use, like Rajendran sort of pointed out. It's very, very critical to provide an extremely easy to use platform for MSMEs in India. And that actually determines whether a product works or doesn't work. The adoption is entirely dependent on the ease of use. So, for instance, one of the things that we've done, which I feel is fairly unique for the India market, is we have vendors discounting their bills on WhatsApp, literally with a click of a button. Now, that was not something that we'd started with, but we realized over time there are vendors who are not very tech savvy and but definitely are in need of funds. So we wanted to cater to that segment. We introduced WhatsApp-based discounting. We cater to their needs in 11 different languages. That was another pain point that we saw, in the supply chain. We realized vendors have, different needs at different points in time. So, we introduced a mechanism where a vendor can discount any time during the credit period instead of at the beginning of the, payment cycle. So many such, smaller innovations, which eventually has led to, significantly high adoption among the base. So if I look at, across our programs, average participation from the supply chain, typically is north of 35 to 40%, which wasn't the case when we started off, right? So it has been a journey for us. I think we've reached now a point where we are truly a product that caters to the Indian customers, and we're able to boast probably the highest adoption rates in the industry as far as our vendor financing platform is concerned. So I think that I would say is something that we feel very proud of, with the endeavors that we've taken.
Got it. Thanks, Ankur. So the next question, we have two similar questions which are around how does it benefit to the company? Is it from the revenue perspective or is it from the cost perspective? And the second part too is that, do you see dynamic discounting as a revenue driver or it's just a strategic thing for like vendor support? So I think it is for you both, Rajendran and Ankur. Would love to hear your thoughts on it.
Yeah. Rajendran, would you like to
Yeah,
go
so
there?
yeah, sure. So see, I think it's completely up to the perspective of how the corporate wants to look at this program. For us in our situation, we have surplus funds and which we can leverage to, of course, do that. But we believe is at their choice and at the rates that they prefer. And hence, I would rather not call it a maximization revenue initiative or a cost reduction initiative, because at the end of the day, if that was the proposal, then you would have mandated that, if he opts for the program, that he needs to discount all his bills in the future, making it a mandatory choice, a mandatory option that he selects. Which is not the case here in the cash flow program. It's up to the vendor on what rate that he wants to discount it at and when he wants to do it and for which bill. So this thing. So I think I wouldn't call it a revenue or a cost motivation. I would say that it's from the perspective that it is a strategic initiative to ease the business process and support the vendor on the working capital side. I think that is what primarily drives the cash flow initiative.
Got it. Thanks, Rajendran. Ankur, would you like to add anything or can you move ahead?
No, I think like Rajendran rightly put it, it's a call on the corporate's end how they want to leverage this facility or this technology. In our experience, most corporates have looked at it as a ways and means to support their vendor base, to ensure there is enough liquidity and there is no supply chain disruption. I think beyond that, yes, there can be benefits that accrue to the corporate, which is essentially, it creates a good long-term sustainable win-win solution, because no corporate would want to also make a loss on their treasury, right? So in a way, this balances their requirements with the supplier's requirements. I think that's quite simply how I would put it.
Got it. Thanks, Ankur. So the next question that we have is from an anonymous attendee. he has asked that how do vendors react to giving you a credit period to pay and then also allowing you to discount to nullify their own credit period. So do we have any view there?
So I think, see, that's not how it works upfront. In end of the day, in a business transaction, there is always a credit period which is negotiated upon upfront between the vendor and then vendor and the supply chain team, and which is part of the working capital. The corporate realizes that there is a working capital cycle to manage, and the credit period plays an integral part and a role of that. This thing. So upfront, there is no concept or a thought behind this vendor discounting or a cash flow or any such thing. The cash flow or the vendor bill discounting thought or a process comes in later at the time after the transaction is complete, and varying upon the need of the vendor at his own choice and at an interest rate of his choice, that he wants to access the payment upfront rather than wait for the due date. So here I think he's enabling himself from his working capital perspective for reasons known best to him as to why he needs the cash upfront, and that's where I think he takes the call. So this is not an program where, or this is not a thought or an driven purpose where we say that, you give a credit period, but you discount it and take the money upfront and nullify your credit period. That's, I think, not the way that I think this gets driven.
Got it. Thanks, Rajendran. This was rightly put. Another question that we have is that the price is as per the vendor, but what are the cost, securities, and guarantee that corporate has to pay?
I have not understood that question very well. Ankur, have you got it? I have not understood what's the cost guarantees.
I think it's a little bit about the risk that the corporate needs to undertake, right? Like I think it's more about I mean, there is a benefit to the vendor here, but is there a risk that the corporate needs to take during this transaction? Who is the risk? Which entity is bearing the risk, right? Like, and how do we?
Okay, got it. I think the risk on this transaction is fairly, there's only one major risk that I see. Primarily, the vendor has completed his supplies and has posed its own due quality diligences that it needs to do. So from that perspective, that this liability and payment is due to him. So I think from that perspective, the risks have been reduced from a corporate. It's not an pre-supply funding kind of a program. So that much is taken care. But what I see in certain situations, that the risk that continues with the corporate is really the challenge that if there are any subsequent discoveries, when the product is used or deployed, and so on and so forth, that if there is a subsequent discovery of a challenge and if there is a recovery that needs to come up, recovery that needs to be done from the vendor, if you had not done a discounting, then you would still have that comfort or an comfort that the payable is outstanding and you could adjust against it, typically for any late discoveries of quality or non-performance under the contract. However, here in the situation, there is a risk that adjust for such a thing. However, if he's a regular supplier, regular vendor, then there is always a continuous flow of transactions and documents in which this can be taken care. But otherwise, yes, this is one risk definitely the corporates have to take note of. And hence, it is in their own interest to do a diligence as to whom they should offer this program to, and whether they will be comfortable facing such a risk in case that was to develop.
Yeah, and just to add, I think we've seen our corporate clients also put in certain discounting limits in place for their vendors. Select vendors where they may not have a regular business with, there they put in a discounting limit that ensures that even if there is a performance issue at a later point, they have some portion of their payables to that vendor held back for any adjustments that need to be made. So those are other ways of also mitigating that risk.
Got it. Thanks, Rajendran and Ankur. The next question that we have is more for you, Rajendran. They have asked that whether the corporates are treating this as a off-balance sheet item, and also are the auditors don't have any objection on the same.
See, this is, as I said, that the situation that we have is where we are deploying our own funds to, effectively to help get the vendors money upfront, and then by then booking a certain discounting income at our end. So at no stage that this gets off balance sheet for us. There is a liability or a creditor that is due and that is payable, and then which we offset by paying him upfront and collecting and discounting income, as I said. So in our situation, there is no off balance sheet funding that's happening. Yeah, so I think.
Got it. So the next two questions are from Mr. Kaushal. He has asked that how should a company with surplus fund use vendor financing program first? And then second, what is the treatment of creditors in books after payment through discounting? So I think let's go ahead with the first question one, which is how should a company with surplus fund use vendor financing program?
Yeah, so this is, I think, fairly an call of the corporate, really, in a sense that you have surplus funds. Do you really, and if you are a vendor to a corporate and such a program does come up, should you participate in that or should you not participate in that? There are many questions that go behind, answering that question fairly well. You have to determine whether you are sure of getting the payment on time. Whether your cost of funds is, whether under the discounting program, you will probably be able to get money upfront, which is probably cheaper than your alternate source of investing that funds. Let us say if you have an requirement to invest, and your return on that capital employed is better than the rate at which you can get the money discounted from the corporate then I think then there can be a reason why you would want to discount it. So I think this is a question that every corporate has to answer. Basis is balance sheet, basis is working capital, basis is cash flow, basis is treasury policies, alternate source of investments that it has, the return on capital that it is able to achieve. I think, and then softer issues, like as I mentioned, that are you confident that you would be getting the payment on the due date from the corporate? So on and so forth. I think those are the considerations that I think each corporate has to evaluate, even if they have surplus funds. So it's not a straight answer. The logical answer would be yes. If you don't have an alternate source of investing that money at a higher rate of return, then you shouldn't discount. But it doesn't work that way. There are other issues that you need to evaluate.
Got it. Thanks, Rajendran. Also, the next question in this line would be that what should be the minimum size of company to avail cash flow service or maybe to do any kind of dynamic discounting program? So is what size or what revenue run rate should they look at when they avail such a program?
Ankur, you're on mute. I can't hear you.
I think Ankur
Yeah.
can answer better as to whether he is.
Ankur, you can take it up. I think it's more relevant.
Yeah. No, happy to take it up. So I think I think there is some lag. Basically, there is no minimum revenue criteria as such. In our experience, companies who typically believe that they have roughly about 5 crores or more to deploy as part of their own treasury, they tend to benefit the most from such programs. That said, we also have companies who don't have surplus treasury, but who know that they have MSME vendors who need financing. We've been supporting such supply chains as well through externally funded programs through our network of banking partners. So I think, short answer is there is no criteria as such to, for a company to embark on this. I think the only thing the companies need to think through is how much can they deploy through their own treasury versus how much support do they need from external capital. And typically a program of 4 to 5 crores is what we've seen companies utilize where they start seeing a lot of value. So I think that's how I would put it.
Awesome. Yeah. No, thanks a lot for that, Ankur. I think in the interest of time, I'm just going to collate a couple of questions, right? I think we're a little overwhelmed with questions right now. But I think we'll take up a couple of tactical questions. And then after that, there are a couple of questions which are more strategic in nature, right? So starting off with the tactical questions, like one is, how does the repayment happen? Does the vendor pay you directly in basically the anchor corporate? Basically, does the vendor pay cash flow directly, or does the corporate repay cash flow, right? So what is the flow of funds in a vendor financing dynamic discounting transaction? Ankur, maybe you want to pick this up?
Yeah, I think it's actually a fairly simple one. There is no vendor repayment required here. Think of this essentially as a early payment to the vendor from the corporate. So let's say if the vendor had an invoice that was due after 30 days, on day 12, the vendor comes in and places a request on the CashFlo platform to discount his bill. The buyer, in this case, a Thermax, would essentially, pay the vendor on day 12 instead of day 30 and extinguish their own liabilities, and the vendor would extinguish their receivables, right? So it's a very clean transaction in that sense. No repayment involved here.
Yeah, super. There's one question around getting suppliers to adopt bill discounting. Basically, we have two similar questions, right? So I'm just going to group them. Basically, how do you convince suppliers to adopt bill discounting, agree to provide documents, become borrowers? And then secondly, what role does CashFlo play with this product, right? Is it a SaaS product here? Or is there some management being done post-integration on CashFlow side, right? So I think they're kind of related. Maybe Ankur, you can pick it up, and then Mr. Rajendran can chime in.
Yeah, sure. So I think the first and foremost thing is, if the funding is happening through the buyer's treasury, there is actually zero documentation needed on the supplier side to be able to avail of discounting of receivables. That's one of the big USPs of this kind of a product. It's probably the only product in the market today where, as a supplier, I can, literally start discounting instantly on WhatsApp without a single document being submitted, no credit underwriting needed, or no bank lines to be opened separately, and it is not even a borrowing on the supplier's books. So from that perspective, the adoption is actually a lot better. To Mr. Rajendran's earlier point during the webinar, that traditional vendor financing programs, take a lot of effort for adoption because of those reasons. But here, since the funding is happening through buyer treasury, the supplier has to do zero documentation. That's point one. Point two, as far as CashFlo is concerned, we are a SaaS platform with a managed services, layer on top. What that means is the technology enables, the information flow between the buyer and the supplier and the platform, in the form of a SaaS business. But in our experience, what we've realized is that technology is only half the, solution. There is a fair bit of hand-holding needed on the supplier side to create awareness, to educate them on the benefits of, such a solution, and to sort of help them get onboarded onto the platform. And even after onboarding, on an ongoing basis, we have a dedicated team on ground that supports each supplier on a transaction-to-transaction basis to help them with their working capital needs. So it's a combination of SaaS and managed services, is how I would put it.
Got it. I think we have one final question which we'll pick up. I think this one's more for Mr. Rajendran, right? Like it says a lot of CFOs focus on ESG and sustainability in today's times. And for you being part of a company that is part of the energy transformation, do you have an ESG charter as well, like within the company?
Yes, I think today large in or rather responsible, I think the journey is an integral part of their future strategy. I think we have own charters built on every pillar of ESG, which we have disclosed it as a part of the BRSR disclosure in our annual report. And certain targets that we would have adopted as a part of that, which we would plan to deliver as we go along. Over and above that, we propose to play an integral part and an trusted supplier in the ESG journey of most of the corporates, because most of our solutions actually are ESG friendly and can help companies achieve their ESG goals. And I think so we play a dual thing on this particular one.
Got it. Got it. I think I personally think it's a very interesting topic. We should definitely have a larger conversation around it at some other time. Just one last question that's coming right now. Do you work on export bill discounting as well, wherein invoices are in USD and customers are Fortune 500 companies?
Yeah, I mean, that's a separate product proposition altogether. I think in context of dynamic discounting, it is largely related to domestic supplies and funding domestic suppliers. Export bill discounting is a separate initiative which we're working on. It's not something that we are looking at on an immediate basis.
Got it. Got it. Super. Okay, I think that's about it. That's all the questions that we have today. In the interest of time, I had to collate a couple of them, but I hope everyone's got their answers. If you want to ask more questions, please feel free to write to us even after the webinar, and we'll be happy to share those questions with Ankur and Mr. Rajendran as well, and come back to you with answers post the webinar. Mr. Anurag, everyone, actually, we can we'll be sending out an email after the webinar with the webinar recording, and you can also write to us at marketing@cashflow.io, and you can also just respond to that email with your questions, and we'll be happy to answer them. Superb. Okay, I think that wraps it up. Ankur, do you just want to closing thoughts here?
No, sure. Thank you so much, Akshay, and Mr. Rajendran, thank you so much for taking your time. I think this has been super insightful. My favorite part is just the Q&A that follows, right? I think a lot of tactical questions that actually help folks think about this for their respective businesses. So I'm sure people will have a lot to take away from today's session and think about dynamic discounting as a value proposition for their businesses. Thank you so much, for sharing your insights and for providing guidance to the larger audience. This has been fun, and we look forward to having more such conversations with you going forward.
Sure. Thank you, Ankur, and I think the opportunity is nice, and I think happy to have been on this program. Thank you.
Super.
Thanks a lot.
Thanks a lot, everyone.
Thank you.
Yeah.
Take care. Bye.